Okay, this is going to be just a short video on Silvergate. This is the third video we've talked about this company. So today I want to point out something that's can be idiosyncratic about companies when there are when it's a tremendous battleground stock between shorts and longs. And Silvergate is giving us a really good sort of learning opportunity to look at different places in the capital stack of a company. So, for example, there's a pretty strong argument that this stock is, it's already down more than 100 points from where it was, say, several months ago, maybe more like 200 points. If we pull up a longer term chart, we can see the stock hit 200 back in the day. Obviously, the bear thesis is that this company breached a lot of rules, basically, and may actually have its banking charter at risk. There's just a lot of things that have played out with the short thesis primarily from Mark Cohodes about this company. And this is not a recommendation to short it here or do anything at this point. This is just an opportunity to kind of learn. And in particular, I want to get across the idea to look at other places in a company's capital stack to corroborate what's going on with the company. So, for example, today we just had a sort of an idiosyncratic day where the stock opened at around 550 and then traded down, but then traded up aggressively. And in fact, it peaked at something like 10%, plus 10% on the day, $6 something. And this is weird, right? If this company really is in deep trouble, why would the stock be lifting like this? And one of the reasons is right here. There's a very large short position. And when you have a short position that's 70%, I mean, basically the rule is if you get to 30 or 40%, at any time there could be a short squeeze in the common stock of a company. And the other thing to think about is there could be very long players that want to get out of this, and if they just sell, they're going to crush the price. And so they may want to actually maybe rumor something or get something to imply that there might be a short squeeze happening to get the stock to lift such that they can unload stock, right? And I'm not accusing anybody of anything, but this definitely does happen. And a lot of this is played out in the rumor mill or even in the media. And this is why they call a company like this a battleground stock. It's just hard to know how it's going to play out in the short run, even though there is a very robust short case on this company. Now, in a case like Silvergate, we actually have something else to look at, which is they have a preferred. And we can see it's the Silvergate A tranche A series preferred. It's 5 and 3.75% preferred paper. And here is where, if you look in different parts of the capital stack, you can sort of cross-check if there's something idiosyncratic happening in the common. And a lot of times you can also look at senior debt of a company or different debt types if there's an active market. And you can identify also kind of what the smart money thinks. And so here's kind of a euphemism to use. The preferreds will be quote unquote smarter than the common when it comes to a distress type situation. Okay, now remember that what we learned about about preferred stocks. Typically they're issued at $25 a share and they're callable and they pay a coupon, usually a quarterly coupon. So if we look here, you look at the history of this thing, yep, it was issued just around $25 and it just has headed aggressively downward. And then of course recently very aggressively downward. And so this is just a very interesting example where, yep, the common stock happens to be up or flattish today, but the preferred is down 21%. And after having been down another 25% just a few days ago, and obviously when you have a preferred stock that has a par value of 25 and it's trading at 4, this really gives you information about people in a different place in a company's capital stack and what they think about this company's ability to fulfill its obligations or fulfill its liabilities. And clearly, this preferred is telling you this company is in tremendous trouble and they are not going to be able to fulfill all their liabilities. I mean, if I were to just be practically blindfolded and I were to see this sort of situation, I'd assume the common stock was a 0 or close to a 0 just from the performance of this common stock. And again, the euphemism here is the preferreds are almost always smarter than the common, meaning that they actually give you the true indication on the health of the company from a day-to-day or week-to-week standpoint, whereas the common stock can give you some idiosyncratic behavior, like today where it traded up, and that might be part of what's happening with people trying to get in and out of the position or rumor it up or down, and of course the contributing factor of the high short position. But if I were a betting man, I'd say this company is in significant trouble. I don't know for sure what's going to happen, but one thing that I want to drive home is you can look at other places in a company's capital stack, and in this particular case, the preferred, and just cross-check and see, okay, yes, they are in significant distress. Okay, so that's it for today. As always, I thank you for watching.